You're watching Silver News Daily. Subscribe for more.
Silver just hit $30, but what if I told you that this rally is about to hit a major roadblock? Yes, we're talking about a sharp pullback that could throw silver's momentum off track. But here's the kicker. Craig Hemke believes this is just the calm before an incredible storm that will take silver to all-time highs. If you're wondering why this pullback could be the perfect opportunity, stay with me as we break down what's coming next for silver. This hook introduces intrigue by acknowledging the recent rally, then hints at a surprising pullback, followed by a tease about a future rally, encouraging viewers to keep watching to find out why Hemke is so bullish on silver's future.
A little worried about how heavy some of the positioning is getting there, but open interest is very low. So there's room for people to come in, and boy, they're coming in today, Elijah. And to answer your question, it's curious. First of all, I've been watching this stuff now for 15 years, every single day. And it's remarkable how the symmetry sometimes. Gold first broke out back during the COVID year, right? And then consolidated and traded sideways in a range for 3.5 years. And then it broke out on March 1st of this year, and then consolidated and traded sideways in a range for 3.5 months. And then it broke out above and out of that range at 25.20 was kind of the high, and traded sideways in a range for 3.5 weeks. Anyway, interesting how that works out sometimes. And so, yeah, what's driving it ultimately? Okay, let's get to your question. Two things today, I think you can lay it on there. One, the ECB, 1 week ahead of the Fed, announced that they were cutting rates today, 25 basis points, which again tells you for sure the Fed, this is a done deal. The Fed's cutting at least 25 next Wednesday when the FOMC concludes. But not only they announced that, they said they're doing that and they're expecting their economy to kind of slug along, not do real well, but they're not sure inflation is done. And it had stagflation written all over it, which is something that you and I have discussed, and I've discussed at my site for about 4 years. I think the first time I ever brought it up was about June of 2020, that was ultimately where all this was headed. So you got this really stagflationary report and rate cut out of the ECB. So that came at about the time the COMEX opened. Then the PPI report came out at 8:30 Eastern, 10 minutes after the COMEX, and it was pretty tame.
Silver has been on a tear recently, climbing to the $30 mark, and it's not just by coincidence. This surge is being fueled by several powerful factors, and if you've been paying attention, you know the dollar is weaker than it's been in years. As the U.S. dollar struggles, silver, a traditional hedge against currency devaluation, becomes more attractive to investors. But it's not just the dollar. The demand for silver is also exploding in industries like solar energy and medical technology. These sectors are growing fast, and silver is crucial to their production, meaning its industrial value is climbing as well. What's even more interesting is how the current geopolitical tensions, particularly between the U.S. and China, are making investors flock to precious metals like silver as safe haven assets. So it's a perfect storm of factors that's pushed silver up to this point. Analysts have been overwhelmingly bullish, with some predicting even more gains on the horizon. But let's not get ahead of ourselves just yet. Despite this rally, there's a chance we could see silver hit a speed bump. Does this mean the silver rally is over? Not even close. Stick with me as we explore why this pullback could actually be the setup for a much bigger move. This section dives into the key drivers behind silver's rally to $30, emphasizing industrial demand, a weak dollar, and geopolitical tensions. It keeps the momentum of the story flowing, while subtly setting up for the discussion on the potential pullback in the next step.
So that's all of a sudden, okay, now we can start moving up. One more thing, Elijah, and this is the biggest thing of all. Later this afternoon, as we record this on the 12th, we'll get the monthly budget deficit numbers from the federal government. It was expected to be really, really bad. And when we get all of the details at 2 o'clock Eastern, it's going to be really nasty because Bloomberg reported then early this morning, the headline number, Elijah, good thing you're sitting down, right? I can see you. It looks like you're sitting. For the month of August, then this is from the Bloomberg report. I mean, I don't know if it was leaked, if they just let the headline number out. For the month of August, the U.S. government ran a budget deficit of $380 billion for the month. 11, 12 billion a day. It's remarkable. A billion every 2 hours, 500 million an hour. Am I doing the math right? I mean, now it doesn't annualize it like that, right? You can't just go, well, it's going to be, 400 billion a month for 12 months and annualize it 5 trillion, because there are months like April, right, where you get, all these tax receipts, or every quarter, maybe June, September, and all that kind of stuff. But this kind of number is going to push the annual number when we get it early in October, when we get the look, because the U.S. fiscal year ends on September 30th. The annual number is going to be 2 trillion or very close to it, which is just outrageous. And then we now are well past $1 trillion a year just in debt service. And so you put those things together and it got us some momentum. We got above that 2560 level and broke out, and, it had to be a whole bunch of stop orders there. People that were short that said, well, on a breakout, I better cover that. And so you've had this steady move up since. Silver's moving higher too. It just tapped $30. So we're having a good day.
Now, while silver's climb to $1.30 has been impressive, we need to talk about the potential storm clouds on the horizon. Even though we've seen strong upward momentum, no rally moves in a straight line, and silver is no exception. The price is currently facing some serious resistance, just above $31, a level it hasn't been able to break through consistently. In technical analysis, this kind of resistance often signals a short-term pullback before the next big move. Remember, markets don't move up forever. There are always corrections along the way. This pullback could be triggered by a number of factors. First, we have the Federal Reserve's upcoming rate decision. If the Fed cuts interest rates, as many expect, it could initially push the dollar higher and cause silver to temporarily drop. Also, recent economic data, like stronger than expected U.S. manufacturing numbers, are adding to the uncertainty. While these numbers haven't been enough to strengthen the dollar significantly, they do introduce some volatility into the market. Silver's rally could lose steam in the short term as investors react to these mixed signals. But here's the key takeaway. This pullback isn't a sign of weakness. It's actually setting the stage for something much bigger. Could this be the perfect moment to buy silver on the dip before the next rally? Stick around as we dive deeper into why this correction could lead to unprecedented gains. This step explains why a short-term pullback is likely, focusing on technical resistance and external factors like the Fed's upcoming rate cut and economic data. It maintains viewer engagement by hinting at the pullback as a potential buying opportunity, creating anticipation for what's coming next.
Getting back to that, I think it was, I just have it in my head. It was June of 2020 when I first started talking about it on my site. That's eventually where this was headed. We didn't know about the $5 trillion that was going to get spent, and flushed out of the economy to keep it rolling to and through COVID. But beyond that, you knew that, any type of economic slowdown, which would then be eventual, was going to be met with even lower rates again and more QE and all that kind of stuff. So the inflation was never going to go away the next time we had a recession. Well, then there you go. That's what stagflation is. It's inflation in a stagnant economy. Very similar to what we had in the 1970s. And I'm sure everybody watching this call has seen the charts, of what gold has done or had done back in the 1970s. Broke out. It was held at $35 an ounce, and then Nixon closed the gold window, and it went from 35 to 200 in a couple of years, then pulled back 50% to 100, and then went to 800. a couple years later. And again, I'm not trying to tell you, we're going up eightfold from here. But this stagflationary idea where negative real interest rates take hold is a very positive scenario for owning gold. Negative real interest rates. And what's a real interest rate? You take your nominal rate of interest, say it's 2% that you're earning, but inflation is 4%. You're actually losing 2% a year in cost of, in trying to keep up with the cost of living and all the other expenses that you have. You're not even keeping up. That's a negative real or inflation adjusted rate. And again, that where this impacts gold as a foundational investment is what is, I mean, for 15 years, well, maybe not so much anymore. I always heard, well, gold doesn't pay a dividend. Right. That's fine. It also, it keeps you up with inflation, obviously. And when inflation is eating away at your savings that quickly, makes it look even better as a foundational investment versus treasuries and everything else. And that's what drives demand for it. And that's why it's so correlated over the years with negative real interest rates.
Let's zoom in on a critical factor that could determine silver's next move, the Federal Reserve. All eyes are on the Fed right now as the market anticipates a significant rate cut in response to economic conditions. There's over a 60% chance that we'll see a 50 basis point reduction in interest rates. But here's the twist. While many people expect this to boost silver's long-term prospects, it could actually cause a short-term pullback. Here's why. When the Fed cuts rates, it's often seen as a signal of weakening economic growth. This can drive investors towards safe haven assets like silver. But in the short term, a rate cut can also lead to a stronger dollar. And since silver's price is inversely correlated with the dollar, a sudden spike in the dollar could trigger a brief dip in silver prices. It's a bit of a paradox. The Fed's actions are bullish for silver in the long run, but might cause some volatility in the near term. Additionally, the market's uncertainty around the size of the rate cut, whether it'll be 25 or 50 basis points, creates even more potential for short-term fluctuations in silver. The larger the cut, the more dramatic the initial market reaction could be. So, while the Fed's decision will likely set the stage for silver's next massive rally, don't be surprised if we see a pullback right after the announcement. The question is, how long will that pullback last? And when will the next rally begin? In the next segment, we'll explore why industrial demand could be the catalyst that drives silver to new highs. This section breaks down how the Federal Reserve's anticipated rate cut could affect silver in the short term, emphasizing the potential for a pullback while also laying the groundwork for future bullish momentum. It keeps viewers hooked by teasing the next factor, industrial demand, that could fuel the upcoming rally.
That's right. Part of me wonders if human beings aren't seeing through the level of BS. Elijah, how many times have we done? I mean, we've been doing these calls for 10 years. How many times have we done them shortly after a jobs report? Have you heard me use the term BLS BS before?
Yeah, definitely. And I think shadowstats.com is a great website to pick out to get maybe a more realistic view of what is going on.
The reason I call it the BLS BS is that monthly jobs number is cranked out by the Bureau of Labor Statistics, the BLS. And it's BS because it's just, how do they know how many jobs the U.S. created when they issue the report on like the third of the following month, right? Here's how many jobs we created in March. Well, it's only April the 2nd. How can you possibly know that? Well, it's because all this statistical gobbledygook based on the last 20 Marches, and they try to guess, it's all. And recently, and I'm sure most people know, you get a headline number of a certain number, and then the next month and the following month, those numbers are then revised lower. Okay, so it's just BS. Well, Elijah, I tell you all this. Not many folks know the same organization that cranks out the jobs report cranks out the CPI, the BLS, the Bureau of Labor Statistics. So when you see little things buried in that CPI report, for example, within the CPI, the calculation of health insurance costs has fallen 31% over the last 2 years. And because it rose in the first, if you look at a 5-year picture, it's down 10%, only because it was rising in 2021 and 22. So the BLS is telling us that in health insurance costs have fallen 31% over the last 2 years, or 10% over the last 5. That is demonstrably false. Not just anecdotally, where, you and I are like, I don't know, that's not true. My health insurance costs are up. It is demonstrably false. Anybody can prove that it's up 31%, if anything. But yet, as a factor of the CPI, we're told it's down. And so, circling around to your question, why would we be rallying if, inflation, is coming in and all that? Well, maybe, like I said, maybe there's some human beings that are finally starting to figure out that they're being fed a level of manure consistently by the government statistics.
Now let's talk about one of the most important and often overlooked factors supporting silver's long-term bullish case: industrial demand. Unlike gold, silver is not just a monetary metal. It's heavily used in industries like solar energy and medical technology. In fact, silver plays a critical role in solar panels, which are in massive demand as the world transitions to renewable energy. The International Energy Agency expects solar energy capacity to nearly triple by 2030, and guess what? Silver is essential in making that happen. On top of that, silver's antimicrobial properties make it indispensable in the medical field, particularly in high-tech applications like medical instruments and wound care. This industrial use adds another layer of demand that it isn't just speculative. It's a fundamental driver of silver's long-term price. But here's where things get really interesting. As industrial demand continues to climb, investment demand for silver is also surging. Investors are increasingly turning to silver as a hedge against inflation and economic instability, especially with concerns around the U.S. dollar's strength. This combination of industrial and investment demand is creating a perfect storm, one that could propel silver higher once the market digests any short-term volatility. So, even if silver experiences a pullback, the underlying demand from these industries is expected to act as a strong support, limiting any downside. And as soon as that support kicks in, we could see the price rebound and rally to new highs. The question is, with both industrial and investment demand growing, how high could silver go? Stick with me as we explore how global geopolitical tensions could accelerate this rally even further. This step emphasizes the dual role of silver as both an industrial and monetary asset, explaining how rising industrial demand, particularly in solar energy and medical fields, is setting the stage for long-term growth. It also teases the next step, linking this demand to global geopolitical tensions and further fueling anticipation.
If you're paying attention, it's pretty easy to see through it. The problem is most folks are living their lives, right? And it's not an easy life to live. Go back to that jobs report from last Friday. The U.S. hasn't added any full-time jobs over the last 2 years. The only jobs that are being added are part-time jobs, okay? Even this most recent month, full-time jobs down, part-time jobs up. The simplest explanation for that is all of the layoffs you've seen. Where the average guy, he's got a reasonably good, white-collar job, if you want to call that, making 90 grand a year, and he's got benefits like PTO and health insurance and everything else, and he gets laid off. Well, that doesn't mean the dude doesn't still have to make his mortgage. He doesn't have to feed his family. He doesn't have to save for retirement. So what would anybody do in that situation, Elijah? Well, while being on LinkedIn or whatever else, trying to find a new job, man, you're going to go sort packages for Amazon. You're going to drive an Uber on the weekend. You might even deliver some pizzas at night. That's 3 jobs. So you lost a good job. You replaced it with 3 crappy part-time jobs because you got to feed your family. And the BLS says that's a net gain of 2 jobs. Okay, so people are out there they sense, I don't know about that. They hear the news, they hear Lester Holt trying to tell them what's going on, and they go, I don't know. But if you look around, if you have the time to look around, and most folks don't because they're trying so hard to keep themselves afloat. If you look around, it's pretty easy to connect all these dots. And again, I get people all the time, oh, come on. Come on. The BLS isn't, they're not politically motivated. Really? Have you ever looked at the demographics of Washington, D.C. and Northern Virginia, where all the government employees work? They're like 95% Democrat. Do you think there's an incentive to kind of cook the books so that President Biden or Vice President Harris can go out and say, oh, look at this great economy, man, 212,000 new jobs. By the time it's revised lower, 60 days later, it's been revised twice, and now it's 110,000 jobs. And actually, they never come back out and say, oh, I'm sorry, I misled everybody. Now you get the headlines, right? And the market loves the headlines too. So again, I probably sound like I should keep a metal hat I can just put on when I talk about this stuff, Elijah. But I don't think it's a stretch to think that there are incentives to either goosing the GDP numbers, goosing the jobs number, keeping the inflation level low, so that in one thing, at least the bond market remains orderly and interest rates don't go to 8-10%. You got to have buyers of those bonds to keep that from happening. And what would that do to the interest on the national debt, Elijah? So there's all kinds of, cooks in the stew. Kind of, I don't want to use the words conspiring, but loosely doing their job, working together to create this. I don't know, what are those things you used to make in grade school? The collages, right? Where you had to like make little things in a cardboard box. That's kind of what they create with all these statistics to make you think that it's real or make it looks like it's real, but it's not.
Geopolitical tensions are another major factor that's quietly fueling silver's rise. Right now, we're witnessing heightened uncertainty on the global stage, particularly in the ongoing U.S.-China trade tensions and the unrest in Eastern Europe. In times of geopolitical instability, investors often flock to safe haven assets like silver and gold. And while gold usually grabs most of the attention, silver has been quietly outperforming due to its unique mix of industrial and precious metal characteristics. Let's take the U.S.-China dynamic as an example. China is a massive consumer of silver, especially for its growing solar energy sector. But the current trade tensions have created uncertainty about supply chains and raw materials. This only adds more pressure to silver prices, as the supply side faces constraints while demand remains high. Then there's the ongoing instability in Europe, particularly around Ukraine, which has led to a flight to safe haven assets globally. Historically, silver tends to perform well in these scenarios as investors seek to protect their wealth against economic disruptions. This flight to safety is pushing more investors into the precious metals market, adding fuel to silver's already bullish trajectory. But it's not just the tensions between major powers. We're also seeing a weakening of many national currencies due to inflation and fiscal deficits, and silver is one of the best hedges against currency devaluation. As global uncertainty continues to mount, silver's appeal as a hedge grows stronger by the day. With so many global factors at play, it's easy to see how geopolitical instability is creating the perfect environment for silver's next major rally. But we're not done yet. In the next step, we'll uncover how central banks and inflation are playing a pivotal role in silver's future trajectory. This step highlights the impact of global geopolitical tensions on silver, using real-world examples to show how these uncertainties are boosting silver's safe haven appeal. The discussion sets the stage for the next section by introducing the role of central banks and inflation in silver's future, keeping viewers engaged and curious about the upcoming insights.
I don't know. There's so many ways to look at that. How do you go directly to a mine? Because mines don't produce metal. I mean, they send doré bars, and then those go off to a refiner, and then the refiner refines them down to the 4.9 standard of, in kilo bars or whatever. So I'm not sure, pick your country that's actively buying gold, Poland, or Turkey or, India, whatever. I'm not sure they'd go to a mine. It also kind of reeks of, why don't they just nationalize their mines, and just say, hey, our metal is ours. So I'm not sure about that. But I do think that the central bank gold demand is significant in a number of ways. Again, the gold pricing scheme as it is now between New York and London relies almost entirely on forward contracts and futures contracts and all these different derivatives, where 1 ounce of gold is levered nobody knows how many times. How much physical gold actually underpins the system that has all these derivatives floating on top of it. Think of it like a pyramid. There's 1 ounce of gold down here, and there's all these forward contracts and futures contracts. So as you remove ounces of gold from that base, the leverage just gets stretched even higher. So the central bank buying does play, just like all of us buying too, does play a role in creating a tightness in that system that will one day force a deleveraging of it. And we'll get to find out what the tide will go out, and we'll find out who's swimming naked. Who is it that's, they own nothing but, promises, promissory notes and warrants and contracts that don't have any gold at all. And they're going to look around and go, wait a second, I was told I had gold. And you don't, unless you got the real thing. So anyway, central bank demand, very important element of why we keep moving higher.
Let's now shift our focus to one of the most underappreciated drivers of silver's long-term rise: central banks and inflation. While most people think of central banks hoarding gold, few realize that silver also benefits from the same economic forces. As inflation continues to erode the purchasing power of major currencies, central banks are taking action, which is indirectly boosting silver's appeal as a store of value. Right now, we're in an environment where inflation isn't just a short-term concern. It's becoming a persistent problem. Central banks, especially the Federal Reserve, have been caught between raising interest rates to curb inflation and trying to stimulate a sluggish economy. This balancing act is creating volatility in the financial markets, and investors are seeking safety in precious metals. But here's something many don't realize. While gold has traditionally been the go-to asset for central banks, silver is starting to catch more attention due to its affordability and industrial demand. And as inflation keeps eating away at fiat currencies, more investors are looking for ways to preserve their wealth, turning to silver as a hedge. On top of that, central banks around the world are quietly increasing their precious metals reserves as a buffer against future economic uncertainty. This isn't just happening in developed nations. Emerging markets are also joining the race as they seek to protect their economies from currency devaluation and potential recessions. This increased demand for precious metals, including silver, creates a strong foundation for future price growth. So, with inflation staying stubbornly high and central banks navigating unprecedented economic challenges, silver is becoming an increasingly attractive investment. But the question remains, how far can silver's price really go? Stick with me as we bring it all together in the final step, where we break down Craig Hemke's prediction of silver's next massive rally. This step explores the influence of central banks and inflation on silver, focusing on how economic instability and rising inflation make silver a valuable edge. It introduces the idea that silver could see even more demand as central banks diversify their reserves, while building anticipation for the final step: Craig Hemke's prediction of a major silver rally.
Own any. I don't own any platinum. I've never even traded options on platinum. On my site, we used to call platinum Sylvia, for Sylvia Plath. Who eventually, anybody that took an English course or literature course who remember Sylvia Plath was this, she obviously had some mental illness, and then one day she just took herself out. And because trading platinum make you suicidal. That was always kind of the off-color joke, because so many times it doesn't make any sense. So I officially don't have an opinion on platinum, but I will offer you this: it's in there with palladium and really silver to a great extent, thought of as a commodity and an industrial metal. The pricing scheme is the same of the leverage of ounces in London and New York. Okay, so all of that's the same. But traders look at it as an industrial metal. I've over the last couple of months, I've often used kind of the analogy of a seesaw when discussing gold and silver, where you've got one end of the seesaw, you've got gold, and the other end you got copper as the king of industrial metal. We might as well put platinum in there with copper. And if gold goes up, but copper goes down, the hinge doesn't move, right? And that's what silver's done. I mean, up until today, or a couple of days ago, here gold is breaking out to new highs versus May, but silver was down 10%. What's going on? Well, copper's down 20. And so, that's kind of an easy way to look at it. If you can raise the whole seesaw, get gold going up, and get all the industrial metals going up at the same time, well, then silver and platinum, everything else is going to go up with it. And we might be kind of seeing a little bit of that at present. But I think, well, anyway, you probably want to ask me about silver, but backing up, platinum is an industrial metal and subject to maybe a little different set of market forces than what gold and silver are. So I just don't follow it that closely.
We've covered a lot of ground, from silver's recent surge to $1.30, the potential for a short-term pullback, the Federal Reserve's next moves, and the growing demand from both industry and investors. But now, it's time to focus on what you've all been waiting for. Craig Hemke's bold prediction of a massive silver rally that could shatter previous highs. Hemke believes that after silver experiences this short-term pullback, it's setting up for one of the most explosive rallies we've seen in years. Why? It's all about the convergence of key factors that are aligning at the perfect time. First, the technical setup. Silver has tested and pulled back from key resistance at $31 multiple times, and each time it has come back stronger. This pattern suggests that once silver breaks through this level, there will be little stopping it from making a run toward new highs. On top of that, we have the macroeconomic landscape working in silver's favor. The Fed's rate cuts, while causing short-term volatility, are creating the perfect environment for a longer-term bull market in silver. Combine that with runaway inflation, geopolitical instability, and growing industrial demand, and you have the ingredients for a perfect storm. Hemke's analysis points to silver not just for testing its previous highs, but breaking through to levels we haven't seen before, potentially pushing silver past $35 and beyond. What's important to remember is that these kinds of rallies don't happen overnight. There will be dips and corrections along the way, but Hemke's analysis shows that the long-term trajectory for silver is undeniably upward. The pullback we're seeing now is just the market taking a breath before the next major move. So, if you're wondering when the right time to get into silver might be, Hemke believes that this pullback could be your golden, or should we say silver, opportunity. Before we wrap up, make sure you're subscribed to our channel so you don't miss any updates as this incredible story unfolds. And remember, while silver looks poised for an epic rally, this video is not financial advice. Always do your own research before making any investment decisions. In this apex, we bring together all the key factors discussed throughout the video and deliver the payoff that viewers have been waiting for. Craig Hemke's prediction of silver's massive upcoming rally. This final section reinforces the idea that the pullback is a buying opportunity and leaves viewers with a clear understanding of why silver could reach new all-time highs.
Today?
Yeah.
Yes, but I'm not one of these like to the moon. I've seen stuff now that, oh yeah, it's going to double before the end. No, it's not. That's not how it works. Bull markets under this pricing scheme unfold all the time in 2 steps forward, 1 step back, where you get a big rush of speculator money that comes in, which I'm sure we're seeing today. And eventually that exhausts itself. And then the price chart tips over and you move back down below moving average, and some of that speculator money rushes out. And then you're set to move forward again. And it's a series of higher highs and higher lows. It's not just straight up. And until there's a delivery default and all that kind of stuff, there's not going to be. So to answer your question, I think another high is coming. We've been saying this all summer. It's really hard if you look at the chart to try to speculate how far it might go when you're at all-time highs, right? It's silver, you can look at it and go, okay, well, there's a reason it stopped at 33 and pulled back. And there's a reason why the next level might be 35, 36, because you can look back 15 years ago or 12 years ago and see the resistance levels there and go, okay, well, if I can see that, everybody else can see it. That's probably the next target. But gold, all-time high territory. There are, though, some trading tools, Fibonacci retracements, that kind of stuff. A whole bunch of them on the weekly chart and the monthly chart all seem to point to about 2650, 2700 as the next target. I figured that was coming more like in October into November. We may be heading there next. I mean, it's still coming. I was personally thinking September might be kind of a challenging month because the last 5 Septembers, Elijah, have averaged down about 3% for gold. Seasonally, it's always been a pretty good month, but the last 5 years have been, So I thought, well, maybe we'd kind of, dance around a little bit here and head lower at least to and through the Fed next week. But now here we are rallying instead. Anyway, either way, must be too much coffee this morning, Elijah. Either way, I think the next stopping point here is another $100 higher. And then, we get another pullback later on in the year as we wait to see, where we're going to go next.